So let's jump right into it. Even as you and I are talking, we're looking at new rounds of all-time highs for the Qs, the NASDAQs, the S&P. Why does investor sentiment still feel so negative with stocks at all-time highs, Ryan?
Well, that's a great question. We've been seeing this for years. I mean, just the continued doubt and worry, and we get it. It's the headlines. I mean, there's war, oil at $100, inflation, all this stuff that it matters. It matters to investors, but how people feel versus what they do. I mean, just a little bit ago, we got retail sales numbers. Came in right about as expected. Yes, we're spending more at gas stations. We understand that. But people are also spending at sporting goods shops. They're spending at retail. They're online. Those things are still strong. So you see one thing, and then, Michigan consumer confidence, lowest we've ever seen. It's kind of this dichotomy. The reality is we keep seeing it. And I just saw The Economist, who's usually a little skeptical. Let's leave it there. The recent cover shows like a person falling into the abyss, talking about the jobs apocalypse, and we can get into more of this if you want, but we're looking at the jobs market like it's improving. So we're being told one thing, people are doing another. I still think that's bullish from that contrarian point of view.
JC Peretz is a good friend of yours. He's a good friend of us on the show, too. Dude, you know how he is with magazines. Oh, yeah. He's the person I saw tweet this out. Are you as into the magazine covers, kind of going the opposite way as JC? It is a big one out today.
Yeah, I am. I started in this industry. I guess I got the bug in 99. But I've been in the industry, working in the industry for over 20 years. I started in options. And one thing I learned about options is if everybody's thinking alike, somebody isn't thinking. General Patton. Now, I'm not just being a contrarian to be a contrarian. I'll be very clear. But when we see certain things like underlying breadth is strong, credit markets are hanging in there, yet everybody's freaking out. And then you see magazine covers like that and some of the other, what was the other one? New Yorker just last week had George Washington all sad, kind of beat up, red, white, and kind of blue. I mean, we don't invest purely on magazine covers. I'll be very clear. But when I see that, JD, I think that's a good sign. And yeah, we pay attention to that stuff.
So here we are. We just pulled it up. Shout out to the producers. That was lightning fast. The jobs apocalypse. Hope for the best. Plan for the worst. And there's a very funny historical correlation between, by the time it gets to this point, it oftentimes does not play out. And by the time something is universally accepted or consensus, it's usually too late. What do you think is the most important thing investors are misreading about this economy more broadly right now, Ryan?
A great question. I'm going to kind of build on the theme we just had. Yes, Carson Group, we can talk about earnings being strong. Every guest has done that and different things. We do think the labor market is really turned a corner here. I work with a really smart guy named Sono Varghese. He's our chief macro strategist. He dives all into this stuff. He's been saying for a couple months now, labor market's improving under the surface. No one's really giving it credit. Now we've had 2 positive numbers in a row, and I get it. It's not like we're seeing 300,000 to 400,000 jobs a month like we were a couple years ago. But our economy, we probably only need between 10 to 25,000 jobs a month, JD, and now we're starting to see that. ADP report's been solid a couple times in a row, being led by small businesses. I know initial jobless claims are still at 210,000, I think, this morning. And one more quick one, the JOLTS data. Quits actually had a pretty big jump last month. It's hard for us to think people are just quitting their job if they don't have a better opportunity. So I'm not saying the labor market's perfect, but I am saying the labor market could be this one thing no one's really talking about the second half of this year that could really help, because we know, the recent GDP number, a week ago, 2%. Well, like half of that was AI. We get it. AI spending, AI rollouts. Last 5 quarters, AI has been 45% of all the GDP growth. So we understand that. But we need the consumer to come back. Consumer is not great, but if the labor market improves like we think it can, that could be a big driver second half of this year that I don't think a lot of people are talking about. Then you see that cover. Clearly, no one's really thinking about it.
Ryan, you brought us a few charts. We're very pro charts here on the JD Durkin Show. We're very grateful. Let's dig into a few of these. Sell in May. Everyone knows that old school trade. Why has the market kept climbing anyway, despite a lot of these old adages, Ryan?
Yeah, first off, I sent you probably like 10 charts. Anybody ever sent that many? I like to know if I'm in the record books. I do love charts. You're right. We love telling stories through pictures and charts. Yes, selling may go away. These next 6 months are, quote unquote, the worst 6 months, but they've also been higher 9 of the last 10 years. And so blindly, we don't think we're going to have a sell and may go away. We've been bullish in the Carson Group. We think this is a bull market, a secular bull market. We can get more into that. But one that I thought was really fascinating, we got 5% for the year at the end of April going into May, like we were this time. The rest of the year has been higher 23 out of 25 times. It's kind of, I call this like it is what it is. When you hear things like that with laying on with different things that we think are still positive, the momentum's a beautiful thing. And one of the things a week ago right now, the New York Stock Exchange advanced decline line hit an all-time high. So usually market breadth leads price. If you want to pick out one potential problem, though, since then breadth has been weakening a little bit. Listen, we've had a huge rally. Maybe we're due for a little bit of a pause, but overall, I don't think you should sell in May and go away this year. We said the same thing last year. We gained, I think it was 23% during the sell in May go away period last year. I don't think we're going to do that again, but it's still going to be pretty solid in our view.
What else is driving your view for a strong summer?
Yeah, well, let's see a couple ways on this. Let's talk credit markets for a second. So again, everybody looks at the economy and this and that. I like to look at I'm kind of a simple guy at the end of the day, and I like to look at what the credit spreads are doing on like triple B spreads, high yield spreads, investor grade corporate spreads. I've said for a long time, if there's a monster under the bed, the credit markets are going to sniff it out before anybody else. Back at the end of March, when we were down 9.1% on the S&P 500, everybody's freaking out. It wasn't like if we go into a bear market, it was when we go into a bear market. And we all see what's happened since then. Credit markets weren't really worried then. And now I look right now, at least as of yesterday, spreads are hitting new cycle lows. And those, again, I think are positive developments under the surface. The other side of this, going to really do a curveball on this now, this is a global bull market. I mean, China, look what Chinese web stocks just did yesterday, right? China's breaking out the 4-year highs. Japan's at all-time highs. All over Europe, you're at all-time highs. U.S. is, all-time highs at the time we're doing this too, right? But I think the fact it's a global bull market, we manage billions of dollars on our team. And we like the U.S. a lot in 23, 24. We were one of the very few places that were pretty bullish back then. But about 15, 16 months ago, we kind of changed our tune a little bit, saying now start to look around the globe. Because just this time a year ago, last comment on this, Germany was breaking out of levels it was trading up back in 2007, just this time a year ago. All right. So to think that, yes, Europe's had a great run, developed nationals had a great run, to think it's just going to be over so quickly, we'd say, probably not. And I think this global bull market's a big theme that we like and we think will continue.
Ryan, on to chart 4 we go. This is the 6-week win streak. We had a 10% surge in just the last month and a half. Why does momentum tend to keep building right now? And do you think investors are at all underestimating how strong the bull run could still become?
Yeah, answer, I guess, the second one first here. I do think investors are underestimating this. I mean, this bull market, we think, is alive and well. But as we're showing on the screen there, when you're up more than 10% during a 6-week win streak, the last time we were down a year later was like 70 years ago. And you can see the average return a year later, 17%. Now, I get it. 1 month, 3 months later, maybe not spectacular returns, but this blast of strength, this blast of buying, this blast of market breadth that we've seen, really off those lows, is not the sign of an oversold market or a bear market rally or just this weak thing that's going to roll over. To us, it's consistent with kind of a new bullish phase. And this is what's, again, I have a CMT behind my name, Chartered Market Technician. A lot of us are scratching our heads to a degree because when we've seen previous events kind of like this, it's come off like major bear market lows or major market corrections. This one's like kind of happened close to all-time highs. So what are the 4 most dangerous words? This time is different. Sir John Templeton. So I'm just pointing out that that's unique, but I still think this is a bullish development these last 6 weeks, and it probably says be ready for continued strong upside.
And let's be ready here for chart. Where are we up to here? Chart 5, I believe. History shows markets rarely peak in May or June. What does that tell us? I got the right chart? Yeah, it is. What does this tell us here?
Yeah.
For potential, but keeping in mind, given Stock Traders Almanac, the work of Jeffrey Hirsch, et cetera, where we are in the 4-year cycle, usually Q2 of the midterm election year, if I'm not mistaken, can be weak, which can set up the sweet spot. But it kind of seems like maybe we're going against a little bit of tradition here.
No, great points there. I know Jay Woods, our mutual friend, has talked about this one before. It's rare to see a major market peak in May and June. You can see right there, we've never peaked in June, only twice in May. So if my math is right, that's 2 of the last 76 years has the market peaked. You're right around now. I don't think this year is going to be the 3rd time. So it's just context to kind of think about. Now, I will say about Jeff Hirsch, I'm a big fan. He was just on our podcast, Facts versus Feelings, last week. He's amazing, right? He wrote the book on Sell and Make Go Away. But I will say this, and this is something I talked with Jeff about a week ago. This is the 6th year of President Trump, right? Now, I get it. It's not 6 years in a row. I understand that. But when you look back the last 50 years, JD, at second-term presidents, their midterm years actually have been higher every time. So I get it. The first term of midterm year is usually really, really weak, which is what we've been seeing lately. So just some context to think about. No, this is not stuff we just invest in gold. It's the 6th year of the president, but it's things to kind of think about because whether you like them or you don't, you know what you're going to get. So maybe you don't get that big pullback. And one more thing on midterm years, years, and lots of people have said this, so I'll make it quick. Average peak to trough correction is 17.5% during the midterm year. Nobody knows what that low is. I think we might have just hit the low, though, at a 9.1% peak to trough correction a couple weeks ago. But off the lows in a midterm year, stocks are up more than 33% a year later and never lower. So no pain, no gain, right? There is usually some pain in a midterm year. And we felt some pain earlier this year, no doubt about it. But then if investors who have a longer term view, I'm not a trader, I'm an investor, I'll be honest. But there's a lot of opportunity still to think that there's still some upside to this rally.
So let's continue on with that vibe right there. Chart 6 and 7. Once a bull turns 3 years old, which is amazing, but not just a bull that turns 3, an S&P 500 that has now doubled during the bull run here. Ryan Dietrich, historically, what happens after after a 100% gain?
Well, the good news is usually good stuff. Let's get a little more into this. So this new bull market started right October 12th, 2022, about a 25% bear market. We've gone up ever since. So we've been saying for a while, this bull market's younger than you think, because again, I say bull market's like a cruise ship, JD. Once they get moving, they're hard to slow down, they're hard to turn around, and they're really hard to stop, right? Like a cruise ship. Well, you can see on bull markets the last 50 years. Once a bull got to its 3rd birthday, every one I made it to the 4th birthday. The shortest any of them went was 5 years, and the average was 8 years. Listen, I'm not saying this bull market's going to go 8 years. We're just saying once they mature like this, they tend to keep going. And then we just cracked over 100% on this bull market about a week or so ago. And I looked at the last 7 times that happened, and sure enough, take a wild guess, on average, it lasts about 3 more years. Now, let's be clear. The 2007 peak happened right about a double. There's a couple others, but these are averages, right? It's that joke about the statistician put his feet in the oven and his head in some ice. This, how do you feel? He goes, well, on average, I feel pretty good. So listen, I understand we have small sample sizes. Averages can be skewed. But still, I think it's important to note that we had 3 years on average left. The previous 7 times we doubled on an S&P 500, and I think this one's probably going to continue to move higher.
Dude, that's really good. So you mentioned the New Yorker cover earlier, and we're also we're pro charts on the JD show. We're pro magazine covers.
There you go.
We hit The Economist. You sent us this one just because it's fun. I mean, not the spirit of what they're trying to convey is fun, but by the time you watch a lot of these big media magazine conglomerates give you some sense on the economy or the markets. What's your take here on a sad-looking George Washington?
Well, I love it from a investments point of view because I want to see that. Now, again, as an older guy, I started this industry in 1999. Let me just tell you, that wasn't the sentiment back then, right? I mean, consumer confidence was over 140 or 145 back then, all-time high. Now we're flirting with like all-time lows on consumer confidence. So it is this incredible situation we're in, and maybe it's politics, maybe it's social media. I don't really have my exact pin on it. I don't know if anybody truly does. I just know that bull markets usually peak on optimism and excitement, and we're seeing pockets of that. And we haven't talked about the wild moves in tech. I understand there's some potential worries. Some huge IPOs are coming out later this year. That's kind of got me a little potentially worried in the near term. But bigger picture, you see things like this, and that is not the hallmark of a bull market that's about to peak. And then you look at the consumer, which again, it's not perfect, but the consumer is in a lot better shape, I think, than most people give it credit. One more thing on this, Sonu does incredible work on this. Looks at like balance sheets, right? How much you're worth versus how much you owe, and goes back 25 years looking at all that data from the Fed. The reality is we are having a corporate, or how do I put this, consumer balance sheets are like in some of the best shape they've been in 25 years. A lot of people own stocks, a lot of people own housing, and I get it. A lot of people are struggling, but on the aggregate, that's my job as a fiduciary portfolio manager. Look at the aggregate. On the aggregate, the consumer is actually in really good shape, and that's going to continue to drive this stock market and economy, in our opinion, higher, at least the rest of this year and probably a little bit more.
Ryan, what is one topic that you wished more people asked you about in financial media interviews?
Ooh, that's a really good one. And I think it's more, and I kind of spin this a little bit, but I just talk about all this stuff. What does it mean for someone who manages a lot of money? How do you construct a portfolio to help financial advisors like we do at Carson Group and their clients? And people think we're just wildly bullish, and we've been bullish. Yes, we've been overweight equities, but you think about a 60-40 portfolio. We're about 69% equities, so 31% other stuff. That other stuff, we've actually had better performance, even though we've been overweight equities and had some good calls, because we've been saying for a while we're in a higher inflation, higher volatility inflation world. And that means if you drop it, hit your foot, and it hurts, you might want to own more of that. So, of course, we own some bonds, but we have short duration. We have managed futures. We have hard assets. We have real assets. We added about 3.5% allocation to gold in our tactical models way back in April of 2023 after the regional bank crisis. People thought we were crazy for adding gold back then. Yeah, that's worked out. So I think it's important to always remember, you're bullish, you're bearish, the Fed, the this, the that. Keep a diversified portfolio. Don't always chase the shiny object. Listen, everybody hated nobody in their right mind, including me, would have told you 16 months ago, go in international, go into Europe, look at Japan. Everybody liked the US, rightfully so. What's happened? Well, listen, keep a diversified portfolio. Don't chase the shiny object. Something's way up here, maybe calm down. If something's way down there, don't just panic and sell it. I work with financial advisors and clients all the time. I can't tell you how many people say, oh my goodness, I sold at the lows of April of last year, or August of 24 during the yen carry trade unwind, or the regional bank crisis. And I get it. I mean, our brains are wonderful things, but they make us make bad decisions the worst possible time. So kind of have a community, work with people, and try to protect yourself from yourself, because we do a lot of great stuff, but sometimes we make the worst decision at the worst time. And I think those are important things to think about when it comes to all this, not just the Fed and bull markets.
I sold specifically on Monday, April 7th, which were the Liberation Day lows. Oh, no, what do I do? I'm sure you heard that a lot.
Oh, yeah.
Dude, you've been, man, I could chat with you all day. I have to leave it there. Where can people go, Ryan Dietrich, if they want to see more of your stuff?
Well, I appreciate it. This is fun. I don't know how long we talked, but this went really fast. So thank you, JD, for having me. Facts versus Feelings is my weekly podcast. Comes out every Wednesday. I do it with Sonu on our team, and we have a lot of fun talking about all the same stuff you and I just talked about. Of course, I'm on X at Ryan Dietrich, RyanDetrick. And the final place, carsongroup.com/research is our blog. I write blogs. Our whole team writes blogs talking about all this stuff. So between those three places, you'll know what I'm up to and what our team is up to.
I'm glad your travels have gone well through the great state of Iowa and beyond. I am incredibly grateful for your time to kick off the broadcast today. The great Ryan Dietrich, my man, take good care of yourself, and we'll talk again soon.
Thanks, JD. Appreciate it.